great to be kicking it off with the opening panel on capital strategies, who's financing the auto market. Don't judge me, I'm a lawyer, so we see it from one side of the table, but know that you guys see it every day from a different side of the table. So Carla Potter here with Castles, but I know you want to hear from who does it every day. You want to hear from who actually finances the auto industry. So won't take long on intros, but happy to have Brian here from Sun Life Capital, Ian, the director and co-chair of the Securitization desk at RBC, as well as Michael, apparently the chair of the CLA. Little tidbit that he left out in our meetings, but and also obviously the head of TD Auto Group. So with that, it's obviously been a pretty interesting 2025. Looks like 2026 is going to be equally as interesting, though I think the answer is there's cautious optimism. There's obviously been political tensions, tariff wars, interest rates heading positively, but obviously uncertainty for a while. So we kept hearing rumors that, capital's pulling back, capital providers are pulling back, but really everyone's, I think, saying the capital is still there. It's just more selective. So on that vein, Ian, what are you seeing? Is there any borrower, dealer channel, or structure that you're actually pulling back from?
Hello, can you hear me? Good morning, everyone, and thanks, Carla, for the introduction. Yeah, it's when you talk about selectivity, let me first level set with what we do in our Canadian securitization business at RBC. We work with both smaller regional independent loan lease originators in Canada, but also with multinational, publicly listed, explicitly rated global captives. So there's the wide universe of clients that we're working with, and it's to finance loan, lease, and floor plan collateral. So with that backdrop, I would just say we are being selective, and I'll get into that in just a minute, but we're also leaning in significantly across all of those different asset types. We're not pulling back from the market. And you see that because the market in general has increased like 30% in the securitization world over the last 2 years. So it's still prime for growth, and the automotive sector in particular represents, almost 40% of that, the aggregated market. So we're seeing significant growth not only in what we do, but specifically for the auto sector. When we talk about selectivity, we look at it across maybe two different ways. We take a look at the servicer perspective. We do a detailed origination and servicing review, and we also look at the credit box into what are they underwriting and what are we financing for them. With respect to this servicing review, we haven't really seen a lot of significant change in their origination behavior. So whatever our clients were originating last year, they tend to be originating the same this year. And while we do see performance normalizing, i.e. slightly worsening, but still better than historical averages, everything seems quite positive. And I think there's some sessions later on today to talk about performance. And on our side, what are we doing? Well, if we financed collateral last year, we're going to finance that same collateral this year. And if performance has been positive, we might fund even more of it this year than we did last year, not only in terms of pure volumes, but we might even loosen the credit box. So we're being selective. We are doing lots of diligence. We're hyper-focused on making sure we're working with the right companies, but at the same time, we are expanding our business. Not all collateral will fit into a securitization, and that's okay. There are other facilities, other takeouts that our clients work with, whether it's funding in the unsecured market or corporate credit facilities, or possibly with Brian or private credit lenders. So there's a stream of other kind of places where assets can be funded. If I had to speak at all to sensitivity, on my side, I'd probably say, and there's a panel on this later today, so please attend it, but leases, shameless plug, but like leases would be something, and in particular like EVs, like leases with residual risk tied to an electric vehicle. We just don't, it's harder to get a pure sense of where that's going. So I'd say EVs, leases in particular. Sometimes we look at longer term auto loans and, vintage used cars, not like used, but like older used cars could be an issue. Having said that, our structures are robust. and they're designed with both concentration limits that we build into the structures and with advance rates that we can mitigate a lot of these risks. So yeah, we're quite open for business.
And what about Brian from the Sun Life perspective? Is this resonating, similar, or?
First of all, I guess I'll say, Ian, good morning, everyone. Ian, I think, said a lot of it. We do a lot of the similar things, for sure. I think, as he noted, where we're probably a little different is we do get a little more granular on the credit box. We are okay to consider some of the nuances. We may require more equity in the deal or something like that. We're okay to do a little portion, learn about the business. For us, obviously, the originator is key to the mark. And if they've been, have the track record or have the battle scars of being through, some of these events, learning, we often find that we learn a lot from them. So we don't know everything going into this. We're not afraid to learn a little bit, recognizing we don't want to be on the bleeding edge of things. So, when I think about people pulling back on the market, I mean, the reality is for us, when people pull back, it actually represents an opportunity because some of the really good originators out there write their best deals when everybody's pulling back.
So that's very optimistic to hear, honestly. It sounds like the capital is there, the pullback isn't there, because really, let's talk about the elephant in the room. It was a tough few years for insolvency within the industry. It's tough to go to a room like this and not hear about Pride or T-Pine. We know when we see fraud, there's really nothing we can do to prevent it, but we are seeing that bust out type fraud that's becoming fairly prevalent within the industry. And it's not going to go away anytime soon. That's a reality. And we're learning lessons from it, but it's what do we kind of do next? So Michael, when you're thinking about, a Pride or a T-Pine scenario, is that changing how TD is looking at risk, or is it changing how you're looking at trust? How is that impacting your relationships?
Yeah, I'd say I don't think it. First off, good morning, everybody. It's I don't think it's changed our view on risk or our risk appetite. It has, to your point, it has changed the trust equation, and it's always been a trust business, and you've made some bets on folks, and you have processes in place to make sure that that your trust is verified from time to time. And I'd say that the number of times we verify has increased to make us feel trusted. So, but that's the biggest change. I think it goes to what these gentlemen were talking about. Understanding better the customer you're dealing with, understanding their sophistication, making sure whether it's a auto originator or a leasing company, understand the discipline that the dealer or the originator has. So it is forcing, I think, some of the smaller players to find it more difficult to do business.
And I think we're seeing that on the legal end. Our clients are saying, oh, our lenders have always had the ability to, exercise their audit rights, but they never had. But now we're seeing them in monthly, or the reporting's really amped up. So obviously the trust relationship is paramount from an originator standpoint. But what about from the securitization provider standpoint? How has this really changed your landscape, or has it?
Yeah, on our side at RBC, not much has changed. There's fairly well-established methodologies in place on which determine how we're going to structure transactions. So Pride was certainly a test for the market, but again, we look to work with established relationship clients of RBC. So we've got multiple touch points, and we're comfortable with the clients before we enter into a securitization relationship. But certain things that we look to and continue to look at are diligence. Like, we always diligence our clients before working with them. Like, prior to closing a transaction, we've conducted one. It's redone on an annual basis thereafter. We get agreed upon procedures audits. I think, Carla, you mentioned those. We've always had them. We've always enforced them on our clients. If anything, I'd say we're looking closer at the procedures themselves. What's the scope of the procedures? Making sure we're getting right back to cash, right? Making sure there's proper parameters around the collections coming in. They're all ring fenced, and their blocked account agreements are in place. We have backup servicers on our transactions for companies that are non-investment grade or not rated. We continue to get legal opinions, true sale opinions. So nothing has changed in that regard. But again, more diligence around understanding the assets, making sure there's no double pledging, which is has been contentious.
Yeah, I would just add that maybe I'll highlight two C's, I guess. One is character, because we often find that I'll say ego and arrogance can often have a lot to play with someone kind of hiding these problems. So there's nothing, just when you judge the character of who you're dealing with, and again, we see a lot of originators who will bring history to us, and they're really afraid to show us the battle scars, the poor performance. And we keep reiterating to them, show it to us. We actually like it because it shows that you've learned. So I can't stress enough, if you've had some learnings in the past and you're dealing with us, tell us about it, because we like that. It really demonstrates a lot. The other is just follow the cash. I mean, if you're looking at the PAP in the accounts and you know that that's lining up with someone, Google their name. Like when you're auditing from us, like we're one step removed from everything. But if you follow the path, look at the house, look at the address. Does this make sense? Is a janitor buying a Ferrari? No. Like these things, it just makes sense.
So it sounds like the way it's really being dealt with is maybe some kind of frictions, let's call it, at the outset. And I know, at least from my vantage point, we tried to eliminate a ton of frictions, particularly over the pandemic, to get deals done quick. So Michael, are you seeing sort of frictions being added at the origination or like at the deal insemination stage? And like, how is that impacting deal timing?
Yeah, there is friction being added, probably not as much as needs to be added to combat fraud. But we are seeing, increased calls for the use of identification and verification up front. Done properly, that shouldn't add any time to the deal. We're also seeing perhaps more calls for registrations to come with the packages. Again, I don't work in a dealership, but I can't imagine putting an extra image in a folder would be that taxing. So I don't think anything that we've done really has added time. There's other things that that we're looking at. This is an indirect model, and you're getting to a decision for $150,000 in 14 seconds. Maybe you want to take a pause and maybe do some more due diligence on an outbound call, right?
Fair,
Something
fair.
like that. But those are things that we are looking at. Those will add friction. But I'd say to date, not enough has been done, and I would say that it hasn't impacted deal time.
Carla,
Yeah,
maybe I can jump in. The other thing I would add in terms of friction on our end would be we have a lot of like rigorous know your client KYC related issues that we go through on our side, and that tends to be taking longer. And the other thing that's taking a little bit longer than in the past, because we're very happy with the asset quality, but we spend a little bit more time with the servicer, especially servicers that aren't known to us up front, who we haven't worked with in the past. We take a much deeper look today at their experience, at their capabilities and quality with respect to reporting. We take a look at their scale, credit strength, and in particular, liquidity profile. So there's a number of factors that get baked into how we assess a transaction, a servicer from a credit perspective. And we also look at, in light of the kind of the pride related issue, infrastructure, governance, and ownership. They're all critically important.
That makes good sense. So if the capital's there, the deals are being done, Brian, maybe from your perspective, like what's one thing that really makes a lender unbuyable? Like deal looks good, yield looks good, but you just can't move forward.
Yeah, that's a great question. Obviously, it's never just one thing, but for us, a lot of it often starts at the CFO level. We find when the CFO has intricate knowledge of the business and they're able to respond to questions and inquiries on the data quality, it speaks volumes about how well they understand the business, how well they understand the funding model that we're doing with them. So we've just found that when that financial advisory role within the company isn't at its full capacity, that's a red flag for us. I think that's probably one of the most important things.
What about from TD's perspective, Michael? Has it changed from an originator kind of view?
Well, I think The similarities are very interesting here. We just have a different
They
customer.
Barry wants disagreement here,
Yeah.
guys.
Well, it's a different client base, but what we're looking for is the same thing. We're looking for sophistication, discipline, processes, and for smaller operators, we want to see more evidence of ability to take a deal back if it happens, and that's the same on a large dealer group. So we are looking for that increasingly. Like five years ago, I'd say that most indirect lenders signed on a new provider with very little due diligence. That's increasing.
So if we have the data, we have performance history, we have governance, like those are your three criteria. What's your most important? Like, how are you ranking those?
Just back to my point, I wouldn't rank them. I'd call that a three-legged stool. If you don't have one, the stool's no good. So, I honestly, I think again, I'll come back to that financial role within the company that makes sure basically most of the governance is in place, that the data quality is there. Obviously, there's, the pressure to grow is always a concern, because that's when the belts and suspenders tend to come off in an organization. So, those things have to be in place as a bare minimum, and I would never take any one of them and rank them one or the other.
Ian,
do you have any kind of add-ons there?
Yeah, I think your analogy of a three-legged stool is a really good one. It is difficult to rank. You need everything to work. At the same time, in our world, if I had to rank them, if Gary were to say create a conflict and rank them, but if he were to ask us to rank them, like governance is a big one. Without proper kind of diligence governance at that level, I don't think there's a client that we can do business with. It's unfortunate, but sometimes the governance issues only get revealed, post-mortem if something's gone wrong. But governance would be, I'd say that's something that's difficult to overcome. Performance history, as long as there's some consistency and predictability in performance, you can overcome it. If there's anomalies historically with respect to data, with the proper explanation, I think we can overcome it. With data quality, as long as it's accurate, it's good. Some issuers will have more robust reporting systems. They'll give us more granular data, more vintage loss information, which is always helpful. But not all issuers can provide that. So where we don't get that information, we might have to create some assumptions. We might have to, stress things a little bit higher, and it could affect the advance rates. But again, we can overcome that. But governance is not one of those things that you can easily mitigate.
Michael, anything else from your perspective, or ditto is a fine answer too?
Yeah, ditto.
Okay, so let's talk about who actually carries the tail risk. So we know that losses may spike, but who really eats it? Is it the bank's balance sheet? Is it the ABS investor? Is it the private credit fund? And who really has the best ability to manage it in real time? I don't know. Want to start off, Ian, or?
Sure. Our deals are largely structured to a AAA equivalent level, so we're not expecting to incur a loss, at least on RBC's end. It's more of a secured funding model where we're providing access to a lower, cheaper cost of funding, but there's not a true risk transference when you're doing a securitization. The issuer ultimately is retaining the first loss on the transaction. So who's wearing the risk at the end of the day? It is our issuer clients. And what we like about that is it continues to align our interests with our clients. If they're going to suffer a loss before we are, so it incentivizes them to continue to maintain the portfolio, to service it properly. We're relying on them to continue servicing the transaction, and the structure will ultimately reward the issuer for good performance. As the performance is good, and once the AAA bonds are repaid, the servicer will be receiving whatever remains of principal in the structure and all their excess spread.
Don't fight over it.
Yeah. Well, as an originator, I bear the risk, and so I just draw the parallel again. I would be your servicer if I securitized, so I'm constantly at the being monitored by my risk management folks for my service history and my ability to manage losses and to grant credits. So ultimately, when we make a credit decision and the loan goes bad, the bank takes the loss.
Anything to supplement there?
Yeah, and the only thing I guess I'll talk to, because it really is the same, bilateral agreement focused on the originator, alignment of interest, that's key. I think when we start talking about forward flow opportunities, where you are, basically fully transferring the risk, that's something where data quality is, even more, there's more of a focus, just because you rely so heavily on the performance of that portfolio to replicate or mirror what it's done in the past. So, I think as you fully transfer the risk, which is happening in the market now, I think, there's going to be some learning lessons there as well, because it's becoming more and more predominant in the market.
Actually, Carl, one other thing I'd like to add is there's also private credit is becoming an important part of the space. And so at times for some issuers, if they don't have the equity to maintain the bottom portion of the facility and they want to get additional leverage, they could enter into a forward flow, or they could introduce a private credit lender into a bottom of the structure, in which case it's replacing like the first loss. They may still be on the hook for the first loss, but there might be a mezzanine piece in there that absorbs some of that, like another shock absorber in the system, and they're commensurately paid for taking on some of that higher risk.
And I think there's a further discussion later today about, the role of private credit too, which would be a very interesting one. So I think we have about 5 minutes left to keep this on track. And from what I'm hearing, I think we're cautiously optimistic about what's happening in 2026. We're certainly at the Castle's end still seeing deal flow, seeing a ton of securitizations happening still. Obviously responding day in and day out to the new KYC requirements, which are coming down. So I think there's a lot keeping our industry busy, and a lot of optimism, or at least cautious optimism, as we go forward in 2026. Sounds like we've all taken some learnings from, the Pride or T-Pine or other events of the last few years, and found ways to implement controls that are actually sustainable, that work for your clients, so you're not interfering with their business, but also protecting the capital. So just on that, if you have one thing to give for like your remarks of what makes a borrower financeable or a lender buyable in 2026, or one tip or one takeaway, kind of let's go through and what would it be? Put you on the spot. Take it away, Michael.
One tip, what? I don't know. Ian.
Question, yeah. But one tip. I mean, you're going to want to be. What do you want to call it? Whatever you do provide us, whenever you do talk to us and present things to us, not only us but our risk management team, you got to have a confidence in what you're sending to us. I think Brian referred to that. Like, don't hide your blemishes. Let's just see what you've got, and we'll structure around things if there's a deal to be done. All right, but we can't. We're going to rely on the relationship ultimately on our side.
Yeah, just to reiterate to that, it's transparency. So ultimately, it's not being afraid to uncover those blemishes to your lender. It starts out with that level of trust. If you don't have it, the relationship, it goes even for your personal relationships, right? How much can you tell your partner, your friend? How deep does the relationship go? Our business is about deep relationships. We have 20+ year relationships in our business. We hope to, continue those on, but it is all about level of trust, transparency, and being confident that you can present a problem to your lender and your lender doesn't react negatively, but positively to help you work through those problems.
So I've had 2 minutes to think about this, but no, I if there was one thing I'd say over the past several years, I've seen a significant shift in the dealer's mind as to their responsibility in the process and AML KYC. And that knowing your customer and knowing who you're dealing with is fundamental to prevent fraud. We have all these other tools, but if we don't do that up front, we're never going to deal with this issue. So I have seen a shift, but there is still a large population out there that thinks that that fraud and KYC is the lender's problem and not theirs. So if I had a wish, it would be that we would transform all of our relationships to really, really care deeply about KYC.
Excellent. Well, thank you so much. I think this has been incredibly insightful about how we're financing the industry and the optimism to look forward. So really appreciate it.